The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
What if there is no defensive playbook? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex D. Are you allowed to say that?
I don't know. I said it out loud.
You did. He said it out loud. But there is one today when you take a look at what's happening with the 10-year, really dropping like a stone after the ISM services here, down by 9 basis points, breaking below the 50-day moving average. Some are saying it's actually a short squeeze, and that's really dominating the overall market action. Remain equities flat, the VIX a little bit softer.
Stocks really are trying to shake off the dent from all of the Trump trade chaos that we've been subjected to. No one, though, is banking on a reset just yet. In fact, trading desks from Wall Street to Brickell Avenue furiously trying to suss out a defensive playbook. JP Morgan launching 11 equity baskets across various regions to help investors navigate tariff turbulence. And Evercore ISI pitching low vol, high buyback stocks as your trade war heroes. That discussion in a moment. Meanwhile, retailers and consumers alike appear to be creating their own defensive playbooks. The latest data from December shows the U.S. trade deficit widening sharply as firms front-loaded imports. And it's not just in retail products. Energy imports from Canada surge, as did industrial parts from Mexico. That front-running likely to continue with the new tariffs on Canada and Mexico delayed until March 1st. And if you're trying to get a package from China, Alex, good luck.
Mexico and Canada kind of agreed to do things that they had already agreed to do. I mean, Mexico had 10 to 15,000 troops on its border going back to 2017 in a promise they made to Trump the first go-around and reiterated with Biden. So, again, how much is political theater? How much is real? We'll have to see. The China tariffs, I think, obviously are a lot more serious and are worth watching.
And, of course, complicating things for investors is the softness that we're seeing in the Mag 7 right at the time when we actually need them most. High valuations and high capital expenditures finally bringing some bullish investors back to reality. Alphabet sinking the most in more than a year. 5 of the other 7 Mag 7 in the red on the day.
Yeah, definitely a big move there for those Mag 7 guys. We get tech after the bell as well. So this great chart comes to us from Bloomberg Intelligence, and it shows what worked the last time tariffs were put on when it came to Chinese goods, for example, back in 2018. The white line is the low volatility stocks within the S&P, and the yellow line are high volatility stocks within the S&P. And the spread between these two is a multiple of 6. So a big wide spread with the outperformance coming from those low volatility stocks. So the questions remain, is that the way you want to be playing the safe haven trade? And will we see a repeat of what we saw back in 2018, or is the landscape different?
It's a lot. We're going to be talking about that today, but some breaking news involving SoftBank, involving Ampere Computing. We have learned that SoftBank is in advanced talks to actually acquire the chip designer. This is a Japanese company. It does have, and you're looking at shares of ARM Holdings right now, but Ampere Computing right now, said to be valued at about $6.5 billion, including debt. This, according to people familiar with the situation. Those folks say that a transaction may be announced in the coming weeks. We're going to keep an eye on that. We're going to keep an eye on SoftBank. And, of course, we're going to keep an eye on the broader markets right now as everyone has a focus on AI and tech. They have a focus on tariffs and trade. And the big question right now is, what do you pay attention to when there's so much noise out there? Jeremy Siegel kicks us off to the close, Professor Emeritus of Finance at the Wharton School of the University of Pennsylvania. Jeremy, how do you look through the noise, or do you not?
Well, it looks choppy to me, and I think you named those two things. I mean, tariffs ahead, and the question of AI spending. Now, we've had some firms reaffirm their spending, but, you know, things can change if fast-moving developments show that the need for high-level chips is not what it would be before. Now, we had a nice bounce today in NVIDIA, but, clearly I think those two uncertainties seem to me to put a cap on any big thrust in the market in February.
Of course, looming all over this is really what's coming out of Washington, or at least the anticipation of what could come. And I know we sort of had a taste of this a few years ago during Trump's first term. This feels a little bit different. There's a lot coming out in a relatively short time, just a couple of weeks here. Do investors, do they just sort of sit and wait, or is there sort of a way to sort of navigate through this?
Well, I mean, we saw the first time, he stepped back at the last moment, which really didn't surprise me. But, it's like the wolf. The sky is falling. The sky is falling, and pretty soon people are going to ignore it. And maybe he will put them on, and that sort of uncertainty is always in the back of your head in terms of what kind of strategy he will have on the tariffs. You're absolutely right. It is much more aggressive now than it seemed to be in his first term. And I think that's an uncertainty that, the stock market doesn't like those uncertainties. So it's going to discount them and keep it from moving higher, even though earnings certainly look good in the fourth quarter.
What's so interesting to me is just a week ago, I was at a hedge fund conference and the vibe was buoyant. I mean, you could just sense that the U.S. exceptionalism theme was running rampant. Everyone was feeling really good. And that has obviously changed now, just like a week later. Does it change again? Like, how do you manage that kind of turn?
Well, I think long run U.S. exceptionalism is still there. And I mean, the Mag 7 is a unique group of stocks such as we have never actually seen before in history. I mean, a group of trillion-dollar stocks which have earnings backing them. I mean, except for Tesla, we're talking about PEs in the 30s at most and some below that. So the group of earnings that they have is also unprecedented in history. Mm-hmm. And so there's very little to know when that trend will stop. Clearly DeepSeek is one threat, but as I say, a prize fighter, takes one blow, he keeps on fighting. Mm-hmm. Normally, for a narrative, a trend to change, you need 2 or 3 factors that convince people that, hey, you know what? I think it might be time for a rotation. But we all know how many head fakes we've had about rotation in the last 6-9 months. 1 or 2 days of bad tech, and then it comes roaring back. So, yeah, I mean, in my look, the trend is still intact. But certainly we've seen some softening in the last 4 weeks.
Yeah, it's so true. It's like just ask the small caps, one day one thing, one day the next thing. So U.S. exceptionalism plus AI, that's there. And the other bucket, though, you have many looking for an expansion of earnings and a rotation within the market and a sign of a healthy market. What would tell you we're in a healthy market?
Well, and clearly, I think what was hoped to have happened was that the Fed was going to lower those short-term rates more. And that does help those small and medium-sized stocks a lot. And when the realization that, we might get only one or maybe no cuts this year, interest expense is much greater proportion of earnings for small and mid-size than certainly the Mag 7 has virtually no interest expense. All capital, all equity. So I think that, that hope that many expressed when the Fed did the 50 basis points cut in September, has basically been dashed by the strength of the economy, the threat of tariffs, the sideways movement of inflation, and therefore the tremendous revision of what is going to happen to interest rates from what we thought 4 or 5 months ago.
Yeah. Well, the good news, at least in the secondary market, you're seeing a big drop in yields today, not necessarily for the right reasons, Jeremy, that 10-year down about 9 basis points right now. I am curious about the impact of the dollar, because we've heard this come up on several conference calls and earnings reports so far this season, that headwind is real and is having a material impact. And if this trade war continues, the theory is that dollar appreciation will be the story.
And you're absolutely right. First of all, tariffs would bring about a rise in the dollar, and it's already brought about a rise in the dollar. 41% of the revenues, and I even think a slightly higher percent of the profits of the S&P 500 come from foreign sales. So a 5 or 8 or 10% rise of the dollar, if you really take the broad one, that really does nick the dollar value of those sales, and certainly is going to be a headwind coming forward, even without the imposition of tariffs the high dollar, I think, is going to be a headwind for Q1 earnings. Of course, we won't have those until April, but it's certainly just something to contend with in 2025.
Professor, we really appreciate your time. Always wonderful to get that perspective. Jeremy Siegel, Professor Emeritus of Finance at the Wharton School of the University of Pennsylvania. All right, our next guest reveals his tariff playbook, recommends buying trade war heroes or low volatility, high buyback stocks. Julian Emanuel, chief equity and quant strategist at Evercore ISI, joins us now. His street notes are obviously a must read for anyone in the market. So break it down. Who are the trade war heroes? What do you think?
So actually, it is interesting because we did take the playbook from 2018, but there's some nuances here because the types of stocks that are now high buyback, low volatility actually intersect in many ways with the AI theme. Right. So think about it. Right. If you are throwing off that much free cash and you're buying your shares back, obviously you're dampening the volatility. And then on the other hand, if you're throwing off that much free cash, you are actually reinvesting it and trying to be convex to the leading edge of adopting and adapting to AI. So for us, maybe it's a little too trite to say have your cake and eat it too, but there is an element of the intersection there. And when we think about how much the AI theme has sold off in recent weeks, we think it's a great opportunity for re-engagement with that theme.
I literally just took a sip of water as you were talking. That was
She's verklempt.
super smart of me to do that. I need my coffee. That's the thing. So then how do you then what do you think about when it comes to, say, valuation, then worries about those CapEx spend? Then how do you offset the fundamentals?
So you definitely, and what we'll say about the bull market in general is almost every client conversation starts with valuation because it is high across the broad swath of the market. And frankly, from our point of view, when the conversations don't talk about valuation anymore, that's when we'll get worried. So we're not worried right now because people are, appropriately concerned. But when you look again at some of these AI names in particular, they have had tremendous discounts to their last 5 years' valuations because of this volatility. And that's sort of where you've got the opportunity for me.
I am curious, though, because when we talk about, let's talk about the AI and particularly some of these big tech companies, I don't think anyone's doubting their cash flow and their ability to continue to grow, maybe not necessarily at past levels. There is some concern about how much money they're spending to chase after this AI dream. And I'm kind of confused because it seems like on one hand, some investors are like, I'm comfortable with it if, you want to spend $80 billion this year or whatever the heck, Microsoft said they were going to spend $65 billion at Meta and who knows what Alphabet's spending. When do you look for a return from that?
It's a function of what the adoption curve looks like. And the great thing about DeepSeek, or as painful as it was in the short-term hit, is that it's galvanizing the psychology. I mean, think about, the government having announced the formation of large pools of capital, let alone the hyperscalers, is galvanizing the idea that the U.S. has to be out in front of this. At the same time, if you're in a corporate boardroom and you really have only given sort of passing mention to AI, you're thinking, okay, it's probably going to cost me less to implement than I thought it was. And it's clearly, still extremely, extremely important in terms of a competitive edge. And so, given the fact that the hyperscalers really have reiterated their CapEx spend plans over the last couple of weeks, we think it is sort of clearing the runway for that next leg higher in these themes.
So when we talk about the broader market, I assume you think that most of the gains that we're going to see this year in, let's just say, the S&P, is that primarily going to come from big tech, or is there going to be broader participation?
So in our view, when you think about the development of a bull market, and particularly given the administration in Washington and the potential for a deregulatory environment, creating a capital market cycle, creating more enthusiasm, really. We haven't seen a huge burst of enthusiasm that you see in the later stages of most bull markets.
This is your year-end target here, 6,800 that we just put on the screen, which isn't the highest on the street, by the way, but that's still pretty aggressive.
It's a very good, solid year after two 20% plus years. But the point, again, here is it is likely that those names lead, but what's really, really good, and I think being overlooked, is the fact that if you look at the last 2 quarters of 2024, the other 493 names have begun to contribute to earnings growth, and there we are.
So wait, so you're saying that it's not a rotation, it's an all and, hence your cake and eating it too?
Very much so. You know, there'll be winners and losers like there always are.
Did you feel though in the winners and losers with AI, are we seeing any rotation into like software versus the chips or something based on DeepSeek? Like, can we get more nuance now in how we play that?
So in our view, you want to skew towards not necessarily the commodity type places, and you're seeing that differentiate a little bit in the market today. But one of the reasons we like software is because it is really on the cutting edge of figuring out how to take AI and put it in an application framework. If you think about it, right, the internet was just this thing in the 1990s, and then you had companies figure out how to actually apply and, you know, create business on top of it. And we think the application aspect is very important.
All right, Julian, great stuff as always. And just to reiterate what Alex said here, those notes are really a must read coming out of Julian Emanuel, Chief Equity and Quantitative Strategist at Evercore ISI. As we do see, Alex here, a broader market trying to sort of find its footing here after being rattled the last couple of Mondays here.
Yeah, and you have to wonder too, when you have earnings coming out, like all the movers in the S&P are all earnings related. There's like no macro trade that you can see. Maybe there's some safety with like real estate doing well, but it's really interesting, and you have a lot of nuances there. So it's some good trading opportunities.
Absolutely. Here, earnings really driving the discussion and driving the market as well. When we come back, we're going to take a closer look at those earnings. Disney, a great quarter. Moana 2 and a boost in subscribers, leading Walt Disney to a first quarter victory. Disney CFO Hugh Johnson said there's only more streaming growth to come. A recap coming up next in our top calls.
This is a business we invested pretty heavily in a couple of years ago, and what you're seeing now is the benefit of those investments. Our expectation is we'll continue to grow subs, we'll improve margins.
All right, let's get a view from the sell side. Top calls, the big movers on the back of analyst recommendations. And we start today with Robinhood. Raymond James starting coverage of the trading platform with a market perform rating and no price target. The analyst says Robinhood's suite of products and services can support an ambitious growth agenda, but despite these positives, he's not a fan of the stock's valuation or its risk-reward profile. Remember, that stock, which at one point was down 90% from its record during the pandemic, up 45% year-to-date, including 3% here on the day. Next up, Warby Parker getting its first sell rating in a year. This after Citi lowered its recommendation on the eyewear company. The analyst calls the stock overvalued and says sales growth has significantly lagged store growth. Citi did, however, raise its 12-month price target to $23 a share from $19, which still implies a drop in the stock price from current levels of almost 14%. The drop today down by about 0.6%. And finally, Mattel upgraded to buy from hold over at Jefferies. The analyst says the toy company is set to benefit from its expansion into entertainment, as well as from broader distribution and new collabs that set the franchise up for top-notch sales growth. Those shares having a phenomenal day, up about 14%, and those are some of our top calls. Good for Barbie, but take a seat for now because there's a new princess getting praised for her box office gains. Her name is Moana, and if I can editorialize here, way better movie than Barbie. The Walt Disney Company says the success of her sequel at the box office, coupled with subscriber gains for its streaming services, made for a magical first quarter. Joining us now to talk a little bit more about the quarter is Jessica Reif Ehrlich, Senior Media and Entertainment Analyst at Bank of America. She has a buy rating on the shares. All right, Jessica, let's get right to it, because this is kind of a tale of two cities. Not all was good in this earnings report. But let's start with the good. It looks like entertainment, the core business of this company, did phenomenal in the most recent quarter, not just on Moana, but really that drive of more folks and profitability to the streaming service.
Absolutely. So, I mean, there were a lot of surprises in the quarter and all on the upside. So, as you mentioned, they had a really good film quarter. It was Moana 2 plus Mufasa. And those movies will wind their way into the streaming platform and drive viewership there. And, of course, every time there's a movie on Disney Plus, people tend to go watch the original as well. So it does drive engagement and subscribers. But the other divisions were really strong. I mean, DTC, the streaming platform, significantly beat numbers. Parks beat numbers, and this is the trough quarter for the year. And sports beat. I mean, it was a pretty solid beat across the board.
But why do you think we're looking at a stock that's down about 2% here on the day. I mean, were investors looking for something more out of this quarter?
No, it's not the first quarter numbers, which beat, I think, most estimates, if not all. It probably was the tone of the conference call was a little bit muted, not promotional because they've changed the format. It's Q&A, and it just depends on the questions. That may be one thing. The other thing, maybe more importantly, is that management reiterated fiscal year 25 guidance, but didn't change it. So they didn't raise guidance despite the beat. Having said that, we already published our follow-up report with new numbers, and we did flow through some of the beat. I mean, it's pretty clear that the streaming business will benefit this year from password sharing crackdown, which has just been started. Netflix did that last year. It was a big driver of subs. Disney has had price increases. They also have more content coming on the platform, and advertising has been incredibly strong on direct-to-consumer. So there are a lot of things going on there, and we believe that there's a big cushion here for the full year.
Okay, just to go back to Barbie for a second, Romaine hadn't seen that movie, so this is not a fair comparison.
No, I saw it.
No, you didn't finish it. Yeah. Okay, this is number one. I just want to point that out. And Moana 2 is not as good as Moana 1. Okay, Jessica, what about their sports venue into streaming, like ESPN on streaming? Do we know kind of how much people are willing to pay for that, how they can monetize that?
So sports is the one division. There's a lot going on. There was a big beat in the quarter, but there's a lot going on in sports in general. So you have venue was shut down. That will be a $50 million charge in Q2. And also there's $100 million of costs, just timing of games and SEC, rights acquisitions, reconfiguration of some of the leagues. So Disney typically will tell you what the headwinds are, not the tailwinds. So they did give us that, the $150 million. But having said that, as we progress through the year, Disney will acquire 70% of Fubo, and they'll have a service with Hulu. So that's one thing. They're going into skinny bundles. That's another thing. And also, of course, they'll be launching ESPN Flagship on streaming probably around the start of the football season, in the fall. So a lot going on. As far as Flagship, all they've said, none of us have seen it, is that it will be personalized with sports betting and a lot more content. I think that most people are assuming or expecting that the price point will be $25 to $30, really geared for one channel, for one network, to the super fan. But even if they get a couple of million subs of cord cutters or cord nevers, that would be a win. They're expanding the base, and it will be on ESPN will be on every platform.
Wow, that's some good perspective there. Jessica, before I let you go, the one part that was a head scratcher were parks in terms of how it's going to fare during the competition. Do you feel like their guidance was solid on that, or do you feel like they're a little light?
I think their guidance leaves, it's another place where they're leaving a cushion. So their guidance is 6 to 8% operating income growth. If you look at the first quarter, they reported domestic parks down 5%, but if you add back those one-time items from the hurricanes and from the pre-opening costs for the cruise ship, which launched in December, domestic parks were up 6% in their worst quarter. So they've said bookings are positive. And you have the cruise ship, the first full quarter it will be in operation, it will be profitable. So as we look out towards the rest of the year, we think that numbers sequentially get better. We know that their bookings are positive despite Epic opening in May, which is Universal's theme park. Most people will not go to Orlando and not also visit Disney, so it will likely expand the market.
Right, exactly. You're not like your kid's not saying let's go to Universal Studios. All right, Jessica, thanks a lot. We really appreciate it. Jessica Reif Ehrlich over at Bank of America. Have you at least seen Moana?
Yes, I told you.
One or two?
Yeah, both. Yeah.
Okay.
So, but I saw Barbie. I just didn't make it through the end.
I literally sing I'm Just Ken on commercial breaks sometimes.
But look, here, Alex, this shows you the diversity that we have in entertainment options out there, and you can make your pick for what you want to see.
All right, fine. Soon they're going to just bundle everything together over streaming, and that's going to be a whole thing.
When is the Deadpool Barbie / mashup? Are they like on the same? That's two different things?
It's different.
Right.
Yeah, but I think you can kind of tell my movie choices. Barbie and Deadpool. Sweet. All right, coming up, we're going to break down real estate. We're going to talk to Compass CEO taking a trip to the NYSE to ring the opening bell. We'll talk to the founder and co-founder, Robert Reffkin, next. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So market's on the front foot right now, right?
Yeah.
Yields coming down. Whether or not that's a good or bad thing is a different story. But I did want to highlight the ag sector is doing really poorly. I mean, FMC is down like 32%.
Yeah.
It's a really rough space right now.
Well, I mean, there's just so much uncertainty there. I mean, you're looking at coffee prices where they're at another record high. I mean, most of the other soft commodities, of course, are getting rattled because of a lot of the trade and tariff concerns here. And then you just have the whole supply-demand dynamics and whatever, weather issues are going on as well. So I don't know how you actually operate in that environment.
No, I think it's really tough. Bunge, ADM, Cargill, all the like. Anyway, that's the worst performing stock on the S&P is FMC, which is an insecticide company. Anyway, one of the largest real estate brokerages in the
I was wondering
country.
how you were going to segue into real
I wasn't
estate.
gonna. I was just gonna do like a pure cut there. But I'm glad that you now talked, and now I can't get the flow back. Anyway, one of the biggest brokerages in the U.S. Is launching a new platform, taking home buying to the next level. You got Compass One is a client-facing dashboard that it connects Compass agents with customers through every phase of the home buying experience. The new technology was developed in-house, and here in studio with more on this is Robert Reffkin, CEO and co-founder of Compass. What is that thing again? Like, what did you do? Why did you do it? Compass One.
So Compass One, it's the one place for all of your home needs. It's the first of its kind all-in-one client portal that gives 24/7 transparency to every step of the process, before, during, and after a transaction for buyers, for sellers, and for owners of multiple homes. It has the full transaction timeline, so you know the 50-plus steps and who's supposed to do what when, if it happened. You know all the search, your comments are there, all the documents and e-signature, forms, files. You have your open house app, you have feedback, you have your pricing and valuation, everything in one place, as opposed to your agent emailing you hundreds of messages and text messages over the course of your time.
So what problem are you trying to fix with that?
What we're trying to fix is, I've never heard a client say, please, please, don't put everything in one place for me, just like Apple does, just like Uber does. I'd rather have 170 emails and text messages. What the problem it solves is it takes away the complexity and makes it seamless. So everything's in one place and you always can go back to that single place.
So, I mean, that's the benefit to the user. What's the benefit to Compass specifically? There's been a lot of discussion about how this tool can be used, and about the idea that if you do get an elimination of a rule that's been in place that effectively allows a little bit more transparency in listing prices, that a tool like this would actually have a great benefit to Compass and your read on where prices are.
Yeah, so my read on where prices are is last year they went up 6% year over year. I would expect prices this year to be more normalized at the historical 2 to 3%. You referenced, there are a lot of these MLS rules which are designed to really quite frankly allow the MLSs to profit from agents and their clients. I'll give you a couple examples.
And MLS, just for our viewers, MLS is basically like the main listing service where you can see all the homes for sale.
Yeah, there are these 500 across the country local listing systems. Yeah. And they have rules like this. An agent can't watermark their own photo, but then the MLS watermarks it. An agent can't put in their own listing description for the seller. Contact me if you see me on a third-party site so that I could show you more information, because I'm the listing agent. They'll take the listing down. They have rules like, in order to access the MLS, you have to pay NAR and your state association so everyone can make money. There are all these rules designed on how others can profit. And what we're doing is we're taking the playbook of the home builders and real estate developers who are not governed by any of these rules. And they have what you call 3-phase marketing strategies, where you can market first internally to a group, then on the public site without going to those portals who put out negative insights on and redirect all the buyer increase to third-party sites. And then after that, you can put it on all the portals with the benefit of price discovery from the first 2 phases, just like the developers.
So are those rules, though, because I was trying to kind of brush up on some of those rules. Are those rules at risk of going away? I know there's been a lot of pushback, including from yourself, but a lot of other folks in the industry have been lobbying to do away with this. Is there light at the end of that tunnel for those that want to see these rules go away?
Absolutely. The Department of Justice is actively investigating National Association of Realtors Clear Cooperation Policy, which says that every homeowner in the country has to give the MLS, which they have a relationship with, has to give the MLS their listing after 1 day. How many homeowners know that they're being forced to do this? They don't. And so there's a quote from Judge Florence from earlier last year who said something to the fact that the DOJ believes clear cooperation, NAR's clear cooperation policy, prohibits seller choices, obviously, because you can't list wherever you want, and also prohibits alternative listing systems from competing. And so that's why the DOJ is looking at this. I would expect, hopefully, that this rule ends in the next 30 to 60 days.
But does the new Compass product, does that become a competing listing service, or is it complementary?
The Compass One product is really just a client dashboard for buyers and sellers that puts everything in one place. There is something else called the Compass 3-phase marketing strategy, which protects sellers from the negative insights and from the lead diversion where you sell the buyer inquiries off to third parties. That's the Compass Private Exclusives, Compass Coming Soons, and then it goes to the portal sites. But in Manhattan, for example, right now, 7% of all listings in Manhattan are Compass Private Exclusives.
Oh, wow.
Can I go broad for a sec?
Let's go broad.
Okay, cool. I was just really curious as to what has happened in terms of inventory as we have 7% 30-year fix, much higher than we were kind of expecting. What's happened?
Yeah, so inventory is up about 25% year over year.
Really?
We're still about 18% less than pre-pandemic levels. That was 2019. At this pace, by the end of this year, it is possible that we could be back at pre-pandemic levels. And as you know, the big issue over the last 4 years was there's just not enough inventory. So inventory is becoming less of the issue. Now the issue is really affordability, which is price and mortgage rates.
Are people freaked out about rates not coming down as much?
Well, today is a good day. Mortgage rates just went to 6.99%.
Got that six handle.
Wow, that's a bargain.
Yeah.
So hopefully tomorrow we're going to hear national headline 6.99.
What's your mortgage rate?
Oh,
She loves to brag.
2.75%.
We'll never have that again.
I know. And I'm never going to move, which is kind of the point. But are you seeing people being like, I can't move because rates are too high? Or they're like, I'm not worried about it. I'm just going for it?
It's a much smaller population now than it was 3 years ago. 3 years ago, 75% of homeowners were locked in at low mortgage rates, 4% or below. Now it's a little less than 50%. So we're making a lot of progress. And mortgage rates really in the high end, it hasn't been as affected. Last year, prices in the high end went up 9% year over year. And that's because when interest rates go up, they are actually recipients of interest income. They're not payers of it. And so we're seeing a real divergence between the high end and the regular market.
All right, illuminating conversation. Robert, appreciate you stopping by here. Robert Reffkin there. He is the founder and CEO of Compass. We want to turn to real estate, to, well, the world of jewelry. Shares of Pandora closing out the day down more than 2% overseas in Europe. The Danish jewelry maker also announcing they will suspend the rollout of lab-made diamonds in new markets due to a lack of demand. Pleased to say that the CEO joins us right now, Alexander Lacik, who says that the company will instead double down on existing markets in North America. So, Alex, talk a little bit about this here. I was kind of under the impression that there was kind of increasing demand for lab-grown diamonds. Did this sort of just stop, or is this a blip? What happened?
Well, I mean, what we've learned a few years back, before we actually entered this segment, we did a little bit of research across China, Italy, US, UK, and Australia from memory. And what we found was that there was different awareness levels. We were mainly focused on millennials. And in the US, you had the by far highest level of awareness of lab-grown diamond. Not that people know a lot about it, but they've at least heard about the concept. And then in a falling scale towards the others. And what we've seen during the kind of 3 or 4 years that we've been in this space is simply that the market, the commercial proposition works better where there's a higher level of general awareness. So looking at it today, we've said, okay, it's moving quite fast here in the US and Canada, I should say. And other markets seem to be kind of tagging on a little bit slower. So we'll probably stay focused on the markets which we've entered, figure out the model even more, and then as time goes by, we'll kind of re-enter the other markets that we had on our kind of schedule.
What are your
there's no drama around this.
I got it. What are your costs looking like right now? I mean, at least in a spot market right now, we look at prices for precious metals, gold, silver, either at or near record highs. Other type of metals traded off the futures market and off the spot market also have risen significantly over the last couple of years here. How does that affect you?
Well, so pre-pandemic, there were 8 years where the silver price, we're fundamentally a silver player. We buy 340 tons of silver each year and 1 ton of gold, just to kind of get the proportions here. And for 8 years up until the pandemic, the silver was pretty much stable on $16 per ounce. Then the pandemic hit, a couple of the mines closed and whatnot. It shot up to 28, then it kind of settled around 25. So a few years back when we did kind of new projections for our long-term financial planning. And since then, they've kind of crept up above 30-ish. The main interesting thing here is that it's not crept up because of more demand. The silver demand is rather stable and is kind of similar to what was pre-pandemic. But what's happening, of course, the more turbulence you have in the world, people then go to safe harbors. That's typically precious metals, so gold, and then silver follows suit. That's kind of been the game. So actually what we are facing is not increased demand, it's just the unrest that kind of keeps happening around us. Now the impact for us as we went from 16 to, let's call it, 25, we managed to kind of cover that through efficiencies and other things. So you didn't see, actually our gross margin as a business went from 74 or 5, whatever it was, close to the 80s that we're cruising at today. Then as it started kind of perking up towards the 30s, all of a sudden now we need to do some additional activity. So you could say that each dollar that the silver moves, it's a headwind of roughly 30 basis points for us. And since the latest kind of long-term guidance that we came with, it's together with gold and a little bit of FX that we're staring a, let's call it 270 basis points of headwind versus the targets that we set out to do. So therefore, we've had to engage in a little bit more pricing, and we are also running a cost program. So we will be able to cover up to the current levels, give or take.
So how much are you raising your prices to account for that 275 basis points?
Well, I mean, last year we took prices up by 5%. Historically, Pandora hasn't really moved prices at all. We did 1 or 2% the prior years, as inflation has gone up a little bit versus the years past. And this year we'll probably do something between the 2 and 5, depending a little bit on where the wind blows, let's say. And then maybe we do a little bit next year. And that, together with some cost efficiencies, should kind of take care of business. That's the current view.
You sell a lot in the U.S., but you produce a lot in Thailand. And I'm just wondering how you're thinking about any tariff risks, particularly with Thailand that exports a ton to the U.S. but doesn't really import that much.
Well, I mean, this is a quite speculative ground. We haven't seen any of those tariffs being imposed as yet. Of course, we've done some scenario planning. But I think it's premature to discuss kind of what type of activities we will have to do to figure out what happens. Because of course there's a big difference if it's a 5% tariff or it's a 50% tariff. The kind of world is going to be different. And the other thing is, a lot of jewelry production globally is actually done in Far East. So I think this is going to then, if there is a tariff imposed on those countries, then we'll probably see the whole jewelry market being affected. So that's also a component that we need to consider here.
And just to kind of remind our viewers, and that's a good point there too, as far as your competitors also being in the same boat, so that kind of evens it out. As far as your own geographic reach in terms of customers, where do you want to see growth the most, or where do you see the biggest opportunity geographically?
So we have somehow, over the 25 years that the brand has been active, developed different maturity in different markets. So if you take Europe, the brand is probably a little bit more matured versus US and Canada as an example. So in that respect, we probably see more growth opportunities in the, let's say, midterm over here. Then if I look at Asia, I think that's probably where we're the least developed. So once we've kind of somehow gotten to a different place in North America, then probably we will turn our eyes towards Asia. But we kind of can do this sequentially. There's plenty of growth opportunities for the brand.
All right, Alex, thanks a lot. We really appreciate it. Alexander Lacik, President and CEO of Pandora, joining us. And earnings out coming today, but really interesting piece on the big take on De Beers today that everyone should read. You can find on the terminal and Bloomberg.com/big take, just about how much that company has struggled and how their pricing model was really out to date and that they cut prices way too late and how that real diamond industry is really struggling.
Well, that's what I'm curious about, too, because we kind of knew what that De Beers model was, which was exclusivity, or at least the veneer of it, and that's helped them gave them a lot of pricing power. That's been removed. And I thought lab-grown diamonds were going to be kind of a part of that equation, at least for this particular quarter. It necessarily wasn't for Pandora. But you do sort of wonder about the competition and how that affects pricing. Yeah,
and does the pie expand in terms of those that own diamonds, or does the pie move to those that don't buy diamonds regularly and they're going to go to lab-grown diamonds? I know a lot of people now who have lab-grown diamond engagement rings. Why spend all that money on a real diamond? And
there are a lot of folks, particularly in the younger generation, say, I don't necessarily want a diamond engagement ring. I want an engagement ring, but I want another type of precious stone in it.
Right. Also, if you lose things a lot, you may want to spend all that money on it. I'm just saying, for those of us who know what I'm talking about. Maybe a little bit. Maybe that's me. Okay, coming up, we're 15 minutes to the closing bell here. It's a pretty calm day in the equity market. The bond market seeing a pretty solid rally with yields dropping. Kristina Hooper is Chief Global Market Strategist over at Invesco, and she'll join us next. This is Bloomberg.
Again, wait and see, but I think that 10% isn't going to do it, by the way. You would have to raise them substantially on both China and the EU, and we haven't seen that yet. So we'll have to see what exactly comes within 30 days, 60 days.
Jim Chanos there giving us his thoughts here on some of the turmoil coming out of Washington and how investors react to it. That conversation aired a little bit earlier here on Bloomberg Television. I'm Romaine Bostic alongside Alex Seal.
Yeah, taking a look at where we are in the markets here. Not really much movement overall on an index level, but if you look at some of the sectors, there is a lot of movement. Take a look at consumer services. Obviously, that's going to be an alphabet story that's dragging on that index. But then you definitely have the health, the players like real estate and utilities on the upside as you have yields move lower. Definitely still a safe haven play on that front.
And it's interesting, too, to see the discretionary names still under pressure. I think maybe that is a part of the growth concerns, economic growth concerns, and obviously tariff concerns as well. But then we were speaking with Julian Emanuel earlier, and he's talking about his defensive playbook, and he's like, well, isn't big tech defensive? I mean, they got the cash flow, they have the resiliency, and why not?
And his point, too, was that you can have AI stocks continue to do well, and also the other 493 stocks catch up. So as he was saying, your cake and eat it at the same time.
Your cake and eat it at the same time. And of course, another big part of the story today is that drop that we're seeing in yields across the board. Here to make sense of it for us is Kristina Hooper, Chief Global Market Strategist at Invesco, counting us down to the close with just about 8.5 minutes until the bell. Kristina, let's start off here with the moves in stock. This is a market that's obviously been rattled the last couple of weeks by a wide variety of things, including what's going on in Washington, DeepSeek and AI and everything else here. Do you see an opportunity for a reset at all? And I'm talking from a broad market level.
So I think there's always the potential for a reset when you have a high level of uncertainty, you have investors walking on eggshells, and you have a portion of the market with high valuations. But do I think that's going to happen anytime in the near term? Probably not, because we still have an environment in which the Fed appears at least open to cutting this year. We heard from Jay Powell at his press conference that he believes monetary policy is still quite restrictive. And so I think that leaves room for some cutting this year, which should ease some of the pressure. And I think also markets have become, as each day goes by, a little bit more resilient to news around tariffs, getting a little more accustomed to this kind of news flow that is much greater than what we saw before just a few weeks ago.
But Jay Powell and the Fed are going to have to get comfortable with it as well, because there are going to be potentially some significant economic consequences from some of these policies. And I know they're saying, look, we're not going to front run this. We're going to wait till those effects show up and then decide. But you're looking at a bond market today. You're seeing a big drop in yields, 9, 10 basis points on your 10-year and the rest of the long end of the curve here. What is that telling us about what Treasury secondary market investors are looking at?
Well, I certainly think that growth expectations are being at least modestly diminished on concerns about what happens to the economy, the impact of tariffs. It's, of course, an impact to the global economy, but also the U.S. economy potentially. But I think also the 10-year can be quite fickle. And so we have to assume that if we were to get good news coming out, for example, the resolution of a lot of the threats around tariffs, that we could see a very different picture emerge. We could, for example, get a good jobs report on Friday that tells us this economy seems to be in better shape. There can be a pretty limited amount of data that can move the 10-year yield. So right now, though, it is telling us we should be worried, at least modestly, about growth.
Does U.S. exceptionalism still reign?
So I think it does, just because in the midst of turmoil and uncertainty, we tend to see a flight to quality. And that usually includes the U.S. dollar. It usually includes U.S. equities. And that seems to be what's unfolding.
If you did want to play the theme and also have some safety, where would the safety be? Like, is it outside the U.S. or is it in different assets in the U.S.?
So I think it's both.
Okay.
I think we want to be well diversified and recognize that there are high valuations, but it's a concentrated group of U.S. stocks. So to even have exposure to more cyclical part of the S&P 500, you can do that and through an equal weighted approach. If you were to have exposure to small caps, mid caps, and also go outside the U.S. because there are opportunities abroad. And in fact, where we can find some of the greatest opportunities can be in those areas that have a lot of negativity priced in. And so any kind of positive news can send those stocks higher.
And we've seen that with some of the earnings reports that have come out. I do want to get your thoughts on earnings season. We're kind of reaching kind of the midway point here. We get a couple of key ones after the bell tonight, including from Qualcomm as well as Ford. We've seen a lot of earnings beats. Do earnings beats even matter, though?
It depends on what your valuation is. I think earnings beats matter more when you are more attractively valued. But when you are priced at perfection or close to perfection, then I think there's a lot more scrutiny. And we've seen that in some of the recent tech earnings.
You're seeing that with Alphabet today.
Oh, yeah, down 7%. But it was at a record high yesterday. So there is that, too, to your point on valuations. Before we let you go, small caps, yay or nay?
Yay.
Yay, even though the growth concerns.
Well, yes, because I think that these are pretty near-term concerns around growth, and they relate to tariff wars. We could easily have these resolved in the very near term, and then we could look out on a reacceleration this year in terms of growth. I think there's a lot of potential there, and I think small caps, not just in the U.S., but globally, can participate.
Well, on the U.S. side, though, I've heard this argument that if you are looking for a defensive play against some of the tariffs and some of the stuff coming out of Washington, that the domestic nature of a lot of those small cap names, at least the ones in the Russell and in the S&P 600, that actually provides insulation. Is that an argument that you buy into?
I think that's a very strong argument, and I think that also extends to mid-caps.
All right, Kristina Hooper, Chief Global Market Strategist over at Invesco, counting us down to the closing bell here on this Wednesday afternoon. Alex, we just have about 3 minutes until we get there. A mixed day here for stocks. We are pretty much in the green across the board, but the gains relatively modest, with the exception of your favorite, small cap Russell 2000.
There you go.
Yeah, up 1%.
Up a full percentage point despite the tariff risks there. So that's a head scratcher sometimes. All right, taking a look at some names we're going to be watching after the bell. You're going to get AMD. You're going to get Skyworks Solutions. You're going to get Qualcomm of Viking Therapeutics. There's going to be a bunch of names Ford that we want to kind of dig through. So it's going to be a nice earnings roundup in the next kind of half hour.
Don't forget MicroStrategy, which I'm told now is just called Strategy.
But why do I care? It's a Bitcoin play. No, please tell me why I care about MicroStrategy's earnings.
I will tell you that during the break. How about that?
There is no break.
Do you care about Aflac? Do you care about Allstate?
I mean,
do you care about McKesson?
My daughter does because
she
knows
Align?
all those. No, I don't.
Crown Cork?
I don't.
I could keep going.
No, keep going. Keep going. We got a lot going. What else you got?
No, but I mean, in all seriousness, though, we talk about kind of the totality of all this and how it does give us a read on a lot of different swaths of our economy and the market. And yeah, that even includes strategy.
I don't get it. In the non-break, he's going to explain. I just don't understand why we care about earnings for something that's a Bitcoin proxy. It makes no sense to me. Just look at Bitcoin. Why not? All
right, a lot to talk about as to what happened in this market. A lot to talk about what's going to happen after the bell. Our full market coverage with our global simulcast starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele taking you through that closing bell. The global simulcast, it starts right now. Scarlet Fu in the TV studio and Looking Lou, Carol Massar and Tim Stenovic deciding to join us for today as we bring together our audiences across all of our Bloomberg platforms. Carol Massar here on a somewhat mixed day here in the market. Screen across the screen, but a lot of different stories driving it.
Yeah, it's kind of fascinating when you think about Alphabet and Uber and Snap and some of these big names that are really seeing some big declines in today's session, and yet the overall trade is higher. I mean, even some of our gainers or decliners are names that we don't typically talk about today.
Yeah, I mean, on one hand, you do have Alphabet and Amazon and Tesla driving the market lower, but you have Nvidia, Broadcom, Eli Lilly pulling things higher.
You know, I wonder also how much data is a driver for today's trade, right? Tariffs are kind of on the back burner right now for at least for the next month for Mexico and Canada. So we're back to staring at the data and thinking about what the Fed does. And ISM Services disappointed. Is bad news good news now again?
Right. And then you got that decline in the 10-year as well when it comes to yields, down by about 9 basis points. Even if it's a short squeeze, that clearly also having a little bit of ripple through. Yeah,
and of course, everyone's still focused on all of the things coming out of Washington, and will that have an impact? And the question we've been asking a lot of our guests today is, do you sort of set up a defensive playbook for that? And if so, what is it?
Yeah, there's so much coming out of investors, right? What do they do? Do they sit still? Do they make some moves? It's really a difficult environment
And we have to talk about as well this idea of this big drop that we're seeing in yields today. Mm-hmm. That could be a net positive for stocks. So I'm not sure exactly what people are buying and why they're buying into the Treasury market, and that's necessarily a bad sign for the economy. The closing bells in New York as we wait for that deluge of earnings across the wire. A Dow Jones Industrial Average higher by more than 300 points, or 0.7%. The S&P 500 up 24 points, or 0.4%, and the Nasdaq, guys, going to close out the day higher by 0.2%.
All right, guys, Qualcomm is out. Let's go right to their outlook. See second quarter revenue of 10.3 to 11.2 billion, and that is above the street estimate of 10.35 billion. So we'll look for subsequent reaction in the aftermarket. Second quarter, actually going back, second quarter adjusted EPS, also the outlook, 270 to 290 a share, and Scarlett, that compares with 269 a share.
And in terms of second quarter revenue, Qualcomm sees 10.3 billion to 11.2 billion. Analysts were looking for 10.35 billion. This is very much a company that's become a barometer for demand for smartphones. And it comes at a time when, of course, Apple is trying to reduce its reliance on this company. So we're going to really wait to hear how it's doing with expanding to newer markets like the auto market, as well as PCs.
Yeah, on the bottom line, first quarter adjusted earnings per share coming in above estimates at $3.41. The company sees second quarter adjusted earnings per share coming in above estimates, $2.70 to $2.90. Second quarter revenue coming in above estimates, or actually at the higher part of the estimate. The estimate is for $10.35 billion. This company is seeing second quarter revenue from $10.3 billion to $11.2 billion. Shares right now in the after hours bouncing around, but higher by 0.7%.
Also taking a look at the broader market, Skyworks Solutions is out as well, looking for second quarter revenue coming in at 935 to 965 million. That is a solid beat. Taking a look at a succession plan as well, Philip Brace will succeed the current CEO and take that helm. That company also looking at adjusted earnings for the second quarter coming in about $1.20. That winds up beating. They did have excess inventory last quarter in automotive and industrial end markets, so interesting to see the read-through on that.
Yeah, and interesting, too, we should point out, both Skyworks and Qualcomm heavily dependent, of course, on Apple. Both companies getting a pretty sizable chunk of their revenue from that relationship, a relationship that we know has been tested. And just going back to Qualcomm for a second, we talk about this idea of where they fit into the broader chip debate as we wait for earnings out of AMD. And we talk about sort of that broader AI narrative and whether there is a place for Qualcomm in that.
No, that's a really good point, right? They've been trying to diversify out of and get away from some of their older business. And having said that, just taking a look at the stock in the aftermarket, Qualcomm is bouncing around. We had seen it a little bit higher. Now it's down about 0.7%. So we'll have to see about, what in terms of growth and where it's coming from is going to be important on the call.
All right. And worth mentioning as well, the comments from the CEO, Kristina Hooper, talking about delivering growth across diversification initiatives. Again, reducing its reliance on the smartphone business and executing reiterating their 2029, fiscal year 2029 targets to achieve $22 billion of non-handset revenues. Again, going back to that idea of chips in cars and chips in PCs. When it comes to chips in cars, NVIDIA is a competitor.
Well, that's what I'm curious about, too, because we've had him on the program, and he has talked about this automotive strategy. And we should point out we are going to get Ford earnings a little bit later this afternoon. And it raises a lot of questions here about the strength of that business as well. More chip earnings crossing the wire right now, I'm told. ARM.
Yep, ARM Holdings, their third quarter total revenue coming in at about $983 million. That is a pretty solid beat there. The company also taking a look at their fourth quarter revenue guide, coming in a touch higher than estimates, that high end about $1.28 billion. And the operating income, a nice beat for the third quarter, coming in at $442 million. And of course, it's that royalty revenue that we want to pay attention to for the third quarter, coming in at $580 million. That is also a beat.
The company is saying in comments to shareholders that AI demand continues to drive strong momentum for the ARM ecosystem. AI growth from the edge to the cloud is creating demand for more energy efficient compute. New AI hardware, the rise of AI agents, and the emergence of smaller, lighter LLMs are unlocking edge AI use cases in smartphones, PCs, consumer electronics, and more. Shares higher so far this year before today by 40%.
Yeah, it's interesting, too. If you have a Bloomberg terminal, you kind of check out the SPLC function. You can kind of get a better read here on which companies that ARM is dependent on. Obviously, Microsoft, Qualcomm, two of its biggest partners, if you will, here. And, of course, that could have a big factor here on how these stocks perform in tandem tomorrow.
All right, MicroStrategy looks like they're just starting to cross in
that
terms
would be
of
strategy.
All right. But right now it's coming across.
Yeah,
All right, strategy. Fourth quarter digital assets, $23.91 billion. The estimate was a little bit below that, $22.54. Fourth quarter revenue, $120.7 million. That's a little light. It was the street estimate was $124.4 million. And fourth quarter number of Bitcoins held, that's what it's all about, 447,470. The estimate was 425,149, so a bit above that.
Why did they change their name to strategy? That doesn't tell you anything about what.
Also, how did the analysts not get it right?
Hey guys, Ford earnings crossing the wire right now. Fourth quarter adjusted EPS looks like a pretty sizable beat, 39 cents a share. The street was looking for 32 cents a share. The company also saying that revenue in the most recent quarter also coming in slightly above estimate at $27.3 billion to $25.85 for the full year 2025. Adjusted EBIT, here's your range, $7 billion to $8.5 billion. The street on average was looking for 8.57. So the top end of that range is below the average of street estimates here. And also just again, looking forward here at those 2025 numbers, free cash flow coming in at about $3.5 to $4.5 billion. That's their estimate for the full year here. It'll be interesting to see if we can get some additional numbers here on what they view in terms of actual production and deliveries going forward and what the mix of that is going to be.
Yeah, well, talking about where the demand is, Ford Blue, which is their internal combustion engine cars, that was up by about 4%. Their Ford Model E revenue, that's going to be their green stuff. It's going to be their EVs, is down about 13%, and it's their commercial trucks that you're looking at for Ford Pro that's up by about 5%.
We should also mention that Ford is going to pay a supplemental dividend of 15 cents a share. They've been doing that at the start of each fiscal year for the last couple of years. So that's something that investors will want to, of course, get as they wait through this restructuring that's taking place, especially for the EV business.
Did you guys see that story the other day that on the terminal about Ford's EV strategy, or maybe some of the concerns about what that strategy is going forward?
Yeah, about the F-150 Lightning and the challenges with range there.
Yeah, but remember, I mean, they had this big splashy rollout, the F-150 Lightning, the Mach-E, and a couple other vehicles. And you're looking at revenue in that most recent quarter from that basically EV division, if you will, down 13% here. And that whole article was kind of calling into question why people have not embraced the Ford models, the Ford EV models, I should say, as much as they've had competing models, particularly some of the Teslas.
Yeah, one concern that was raised in that story was that the Cybertruck, which was widely seen as a niche product, recently outsold the F-150 Lightning, which I think to a lot of people is pretty surprising. The company certainly changing its strategy when it comes to EVs. It's pretty wild to see the transformation because just a couple of years ago, the wait to get one of these was so long, they couldn't make enough of them.
All right. All right, guys, you've got Ford down about 6% here in the aftermarket. Qualcomm now up about 2%, and ARM down about 4.8%. So we're seeing some big movement here in the aftermarkets. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We'll see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television as we take a deeper dive into the tech sector as we await those earnings out of AMD. But we've already got a little bit of a read as to what's going on out of the chip designer ARM and out of Qualcomm. Joining us right now to discuss is Tom Giles, Bloomberg's executive editor of technology. And Tom, I do want to start off with Qualcomm. This has been an interesting story. The shares higher here, a smartphone company to be sure, but the CEO has made it clear he's looking to transition away from that into autos and maybe even deeper into AI.
Yeah, I mean, this shows that Qualcomm is starting to reap some benefits from that expansion into new product areas. They have been known for years for, as you said, smartphones. That's also an area where we've seen some mixed results lately. The smartphone market generally is not putting up the growth numbers that we have seen in the past. However, Qualcomm, particularly benefiting from its presence in high-end devices, particularly those from Samsung. So Qualcomm benefiting from being in high-end smartphones and benefiting from expansion into new areas. Really need to diversify away from that single product, the smartphone.
And diversify away from one of its biggest customers, which is Apple, and that is likely to happen by the end of next year. How is that effort going? I mean, is it picking up enough business from other customers and from other markets to compensate for that loss of that big customer?
Yeah, absolutely. I mean, Samsung is really clutch here. Outside of the U.S., Samsung does very, very well in certain markets in terms of, demand for smartphones. If you're in parts of Asia, that is a real go-to brand. We take it for granted here in the U.S. that Apple is this ubiquitous device that everyone's got. You've got the texting messaging back and forth. You can tell if somebody's not an Apple user, right? Outside of the U.S., that's not a given. And so Qualcomm really benefits from that. Again, Samsung being a really key component.
Tom, I want to get your thoughts here on some of the earnings that we got out of ARM Holdings. Of course, this is more of a chip designer, and they sell a lot of equipment here. Those shares down here, and that's raising a lot of concerns here about where we stand in this AI CapEx spend. Obviously, they're supposed to be one of the beneficiaries of that. Is there cracks in that? I mean, of course, I'm sure you had a front row seat to the DeepSeek news, which seems like it was like a year ago, but it was just a week and a half ago. I mean, where do we stand? I mean, since that, all these tech companies have come out and said, yeah, we're still going to spend billions of dollars a year on this development.
That's right. I think with ARM right now, people are looking at the forecast. The numbers are just crossing the wire here. So we're still digesting it. But the fact that the shares are down shows that people are not pleased with what ARM is sharing with the market right now. Tepid forecast. And as you pointed out, there's a lot of questions about how much people are going to need to spend on AI-related infrastructure, particularly chips designed by ARM. If DeepSeek is as efficient as they say they are, if they can do as much as they say they can at a fraction of the price, do the Metas and Microsofts and OpenAIs of the world need to spend as much as they are projecting? That is certainly not slowing down the projections you saw for Meta. Mark Zuckerberg coming out last week and saying, we're spending on AI, we're going to be the AI leader, really bold talk, no sign of slowing down from him, for example, and Meta, which is a major spender on these components. ARM should be benefiting from that, but clearly someone in the market, there are investors in the market who are raising questions about ongoing demand for as much AI-related components as you might have thought.
So let's go to the granddaddy of them all, which would be NVIDIA. It doesn't report earnings for another 21 days, and I know that's an eternity in Wall Street time, and certainly for investors who are looking at day-to-day trading price action. But in terms of how the conversations that we've had on the chip makers that have reported, what kind of expectations does it set for NVIDIA and how much it's likely to deliver in terms of information on DeepSeek and what it means?
Yeah, I'm just looking at the stock price of NVIDIA, NVDA, equity GIP post. That'll give you a sense of the trading. If I'm reading it right, it took a dip down right after those ARM numbers, but we're back up to close to closing, and they had a pretty good market. They had a pretty good run today, and they're down from their highs, but NVIDIA has retained a lot of its value in spite of what we saw from DeepSeek. Again, after a little dip after the market, they've come back to where they closed. We're not far from those really high valuations for NVIDIA. So the market right now is, I think, looking at NVIDIA and saying, we think they can withstand it. A lot can happen in the next 21 days, and we'll be watching NVIDIA's share price very, very closely, especially as we hear from ARM in their call and hear from ARM executives who I think will be talking to us at Bloomberg in the next day or so.
All right, fantastic. Tom Giles, Bloomberg's executive editor of technology, joining us from San Francisco. We're going to stick with semiconductors and the broader AI sector and bring in Jessica Inskip. She is director of investor research at stockbrokers.com to discuss. Jessica, Tom mentioned that we're going to be waiting to hear more details from ARM on DeepSeek and what it means for demand for those AI products. How are you thinking about what we're going to learn from ARM and how that kind of sets or resets the narrative going forward?
Yeah, absolutely. I think the whole sell-off that happened with DeepSeek was actually very overblown. There was even news today of some potential data concerns that have to do with DeepSeek. Wall Street, I don't think, is necessarily recognizing exactly what it costs to have those type of models and bring them to life, or even taking into account the R&D spend that happened with DeepSeek in order to have that to come to life. Additionally, any efficiencies that emerge or any calls that are telling me about the efficiencies that DeepSeek claims to have is good for the overall AI race and AI narrative that we're all focusing on.
So the hand-wringing over how much money different companies are spending on CapEx. I mean, we're still far too early in the process of developing out this technology to be concerned whether Meta sticks with $65 billion or raises it, or Microsoft changes its $80 billion forecast for this year. I mean, in the end, none of these companies made any adjustments, even with the input of DeepSeek and changing the narrative for what it costs to build out these models.
Exactly. Yeah. And we're still in this LLM GPU rush, but we're still also very early on in this AI revolution. The next race is to AGI. It's all about artificial general intelligence. And there's lots of models that have come up, and this prize that's associated with that, and the goalpost is even moving. But you can see how we're really adjusting from there with AI agents, AI operators that's been released by OpenAI, another one by Google earlier, and then Google also released Gemini 2.0 today to everyone. It was announced December 11th, and then today it now is available to everyone. And I think this is part of critical game theory. We were talking earlier about what Mark Zuckerberg was saying, and essentially it's this all this CapEx spend. It doesn't matter how much is being spent. They want to be participating in this game. We know that we're at this race for artificial general intelligence, but what exactly does that look like? What is that going to feel like? And Zuckerberg himself, it was a great interview with The Verge, said, I don't know if it's going to be this astronomical moment. I don't know what it is, but he knows he needs to get there. And I think that's just interesting and speaking to the whole CapEx spend that we're seeing.
It is interesting. And I'm just going to be the sourpuss here for a second, because when I hear Zuckerberg say that, and I saw that, I read that interview, and it's like this idea of, well, we have to be there, so we're just going to throw everything at the wall. That's fine. But when you're throwing, $65 billion at the wall, that's a whole different story. And I do wonder, Jessica, when we start to see the fruits of that labor. I mean, you talk about the release of some of these new products. What we didn't hear from a lot of these companies was how much revenue they're generating from those new products, or how additive they may be to existing revenue.
Yeah, I completely agree with you there. And I think that's why we're seeing some cost cutting now coming across. But I think we have to point it back at NVIDIA. Every time I write an AI research report, I personally try not to point it back to NVIDIA, but it always ends up there. And I find that ironic nonetheless. But that's where the revenue is coming from right now. And I think it is more than just chips. And we're fixated on really this short-term CapEx spend and GPU demand. But revenue, I think, will be NVIDIA for now. And then there's others that are coming out, not necessarily Meta. I think in the near term, if we're thinking about AI agents and AI operators, I think there's better opportunity in Google and Microsoft, actually.
I mean, I created this whole basket of kind of AI-related stocks or stocks that would benefit from AI. And I know that the big trade has still been around those big tech companies. But have you seen any evidence that investors are looking for something other than, the Microsofts and NVIDIAs to really benefit from this? Is there another tier of companies out there that could benefit that maybe aren't at astronomical valuations already?
Well, so one, I want to comment on that astronomical valuations. A lot of people tend to look at that PE ratio, and it depends on how you feel on that equation. And perhaps the earnings isn't necessarily recognized, therefore the valuations may not be overhyped. So it is definitely the way I feel about NVIDIA. However, sure, there are other ways that it can come in. We saw that with CRM and Salesforce, where we have active AI operators that are coming to life, expanding profit margins, reducing expenses. And that is where I think we could see opportunity as it broadens out. I think that's still a little farther in the future. We're still early on this AI revolution, if you will. And so as we're focusing on expanding to that road to AGI, it's still the software, hardware, those that are creating the AI ecosystems that are going to benefit the most more than the other securities, really.
All right, Jessica. Jessica Inskip, Director of Investor Research over at stockbrokers.com, Qualcomm, getting a modest bid here, as is Supermicro and a few other AI names, ARM, under pressure here in the after-hours trade. In the meantime, we do want to take a look at one of the big decliners in the after-hours trade, and that is Ford. They just came out with their results, and a lot of concerns right now about their pricing power going forward, largely because some of the comments coming out of their new CFO. Stephanie Valdez Streaty over at Cox Automotive going to be joining us in just a bit, as is the CEO of Ford, Jim Farley. This is The Close on Bloomberg. Shares of Ford falling in the after-hours trade, the company out with their earnings. In the most recent quarter, revenue did rise up about 8% on a year-over-year basis to $48.2 billion. Adjusted EBITDA also rebounded nicely, up about 91% year-over-year. But some concerns here about the forecast, which coming in a little bit light. The idea that profit could fall by $2 billion or more this year, with a huge drag coming from its EV business. Stephanie Valdez Streaty joins us right now. She's Director of Industry Insights at Cox Automotive. All right, let's start with the overall picture here. And the idea that sales are okay, but obviously there's a profitability issue. And this gets to the pricing power that Ford, and for that matter, its peers, seem to have had over the last few years. Has that pricing power pretty much been tamped down?
Yeah, you hit on it. I think affordability is the number one issue. And if we go specifically to EVs, right, there's still a price premium of about $7,000. And so we've seen a lot of incentives that really have driven sales for 2024 EV sales. And I think there's a lot of pressure on OEMs to build more affordable vehicles. In fact, in 2024, we saw a shift from these large SUVs, full-size trucks, to really subcompact SUVs and mid-size. So that just points to the affordability issue. And so I think for Ford, not having any new products coming out in the next 2 years, and to really sell the current products, they're going to continue to have to put incentives, price cuts, and even more programs like the Ford Promise. That's, the free installation of a charger, things that are going to sell those current models until they can come out with some new fresh ones.
Well, it's interesting, too. I mean, looking at the business, the breakdown here, and actually seeing a bump up in their, I guess, traditional gas business in Ford Blue, and seeing that drop in revenue in the quarter from the EV business. There was some criticism, I remember a couple of quarters ago, when Jim Farley and some other executives kind of hinted that maybe they were kind of not quite leaning as much into EVs anymore. And everyone was like, oh, how can you abandon this strategy? Is EVs right now, at least based on their cost inputs, is that still a viable strategy for growth?
No, I definitely think it is. Because when they talked about last year, really focusing on the core business, right? Mid, full-size SUVs, commercial, and really focusing on getting this team to come up with affordable EVs and canceling the 3-row SUV full battery electric to become a hybrid. I think that was a smart move. And we've seen it in the data. We're forecasting about 15% of sales in 2025 will be either gas or plug-in hybrid. And so I think for Ford to really take advantage of that, their Ford Maverick, The Ford 150 hybrid has done well. So if they can keep that momentum, I think they're going to really be able to carve some market share into that hybrid space.
Stephanie, I got to ask you about the warranty costs. Those have been a concern, the warranty repair costs earlier in the year, and they've weighed on profits. Do you get the sense that we're past the worst of it?
I think we're past the worst of it, but I still think they need to be diligent in really figuring out, like, how do they overcome all those, because that definitely hit into the profit. And I think even as they start to go, especially looking at EVs with new technology, they're going to have those warranty concerns. So I think they really need to get a better handle on it. But I think the worst is over.
All right, so the worst is over there, but then they have to make sure that they have control over quality and whatever cost cuts they do, and they're targeting $1 billion in cost cuts this year. Don't compromise the work that they're doing on bringing down those warranty costs and, of course, continuing to sell the cars right now that are available. Give me a sense for how Ford should be framing the downside of the tariffs, because we've heard from General Motors that they had a better than expected guidance, but they weren't willing to give details. And it's difficult to get details when you don't know what's going to happen.
Yeah, I think for manufacturers, anyone in product planning, that's the hardest job, right? Trying to navigate these regulatory changes. And I think the industry really needs more certainty. So I think, manufacturers, they plan out years in advance. But going back to the potential tariffs, I think Ford, none of the manufacturers are immune. Ford, for instance, for the Mach-E, it's built in Mexico. And also, it's not only where they build them, but the parts. So I think the tariffs could have a huge impact. We are looking into the details. Potentially, this is kind of average, but a 16% increase on the price on vehicles if those tariffs come into fruition. So definitely could impact that bottom line.
Yeah, and that's something that is going to further exacerbate concerns of consumers who are already grappling with these high prices. Stephanie, really appreciate your joining us. Stephanie Valdez Streaty is Director of Industry Insights at Cox Automotive. We think we have it hard when we have to replan our show around different executive orders that come out, but imagine being a CEO and having to figure out how you're going to give forecasts when you don't know what the tariffs are going to be.
No, I don't envy their job at all, but it's the reason why they get paid $10, $20, $30 million a year, a lot more than we do.
All right, coming up, we are going to hear from the CEO of Ford Motors himself. Jim Farley will be joining us next. Remember, this is a company that just announced a special dividend of 15 cents a share on top of the regular dividend of 15 cents a share, asking investors essentially to be patient, what they did at the start of 2024 and the start of 2023.
They're going to have to do something to placate investors here. I don't know if this is really truly a story about growth or if this is a story about managing expectations.
Yeah, it's a question we'll put to Jim Farley next. From New York, this is Bloomberg. Ford Motors is out with its latest earnings report. Adjusted earnings per share for the fourth quarter beat the average analyst estimate, but you're seeing the stock drop in after-hours trading because of the outlook. Ford warning that profit may fall by $2 billion or more this year on an expected drop in vehicle prices as well as costly new model launches. And of course, behind all of that, you also have concerns over new tariffs under President Trump. We now want to welcome our TV and radio audiences across the globe, because joining us now with more is Jim Farley, CEO of Ford. Jim, thank you for joining us today. Really appreciate your making the time. I want to ask about the expected drop in vehicle prices. Is that something that is across the board that we're seeing in the industry, or is that specific to what you're seeing at Ford?
No, I think it's across the industry. We're seeing all around the world. After COVID, all vehicle prices really went up. But with the acceleration of EVs, as well as inventories normalizing for customers and dealers, we're seeing the prices come down across the globe. And affordability is a big concern for customers.
Yeah, it certainly is. And you, of course, have some new model launches that will be coming up in the years to come. But in the meantime, it's a matter of managing through this interim period. And during this interim period, there are a lot of question marks over tariffs. The tariffs that President Trump had planned to impose on Mexico and Canada have been pushed out by a month. How does the company plan to take advantage of this 4-week delay that was announced earlier this week? Will you be stockpiling inventory, for instance, to get ahead of that?
Well, I think Ford is among the best industrial companies that's scrambling. We have the largest U.S. footprint of any car company. You can imagine we're increasing our component supplies, both at the company and our suppliers, and we're adjusting both our Mexico as well as our U.S. plants to make sure nothing crosses the border. I think longer term is the bigger concern. These kind of tariffs, especially in these two countries, are very significant, and if they persist beyond months, we could see billions and billions of dollars of pressure on the industry, lost jobs, lots of impacts to communities and our ecosystem in the industry. And that's what we're talking to the administration about and congressional leaders.
So what kind of communications have you had with specifically with the White House officials about either tamping down some of these potential tariffs or assuming that Trump does go through with them, how, if at all, the auto industry either could be compensated or in some way have that impact mitigated?
Well, actually, we spoke as an industry, Mary, myself, John Elkin from Stellantis. We all kind of said the same thing, which is 4 years ago, we committed to the USMCA tariff requirements, and all companies have done their job to make sure our vehicle and components are USMCA compliant, and we asked for those to be exempt because it's a trade agreement that we all agreed to actually with the Trump administration. We think that that's only fair. Look, right now, this tariff as proposed is a windfall for South Korean and Japanese companies who can import millions and millions of vehicles without these tariffs. Meanwhile, we have USMCA compliant vehicles and components that are susceptible to this, which will have all this devastating impact. So what we're asking for is a reasoned policy around tariff that's not just these two countries, and we understand the pressures on the border and illegal drugs, but it's more comprehensive. We also have to work through CO2 policy as well as tax policy with the IRA.
So what is your strategy then to navigate this? I mean, this isn't going away, whether it's 25 or something less. This specter is certainly a big part of the president's playbook to address the issues that he wants to resolve here. You can't just up and move a factory overnight, Jim. So what exactly are you strategizing now with your team to make sure that not only you're producing the cars you need to produce, but you're producing them at a cost that's reasonable to you and, more importantly, reasonable to the customer?
Well, first of all, Ford is in a very fortunate situation. We decided many years ago to have an outsized footprint in the U.S. So our manufacturing footprint, the number of vehicles that we make, 80% of our vehicles sold in the U.S. are made here. All of our transmissions, most of our engines. So we have a really big advantage compared to our competitors. But there are optionality that we can make. And look, we've localized a lot of battery plants and EV production in Tennessee and Kentucky because the production tax credit is there. So we're really asking the administration, please preserve the production tax credit. Let's have a reasoned tariff approach. And most of all, let's have reasonable CO2 targets that are in line with what customers are actually buying.
Do you have spare capacity inside the U.S. right now of significance?
No. No, we are maxed out in the U.S. As I said, we're the largest U.S. producer. We export more cars. A lot of people don't realize that Ford exports a lot of cars outside the U.S. We don't have a lot of excess capacity. A little bit, and we're taking advantage of that, and that's why we're building new capacity in Ohio and Tennessee and Kentucky for batteries and these new EVs that will be coming out in the next couple of years. That's why we're investing in the U.S.
Tariffs are clearly on everyone's mind, and that's something your CFO has made in her statement as well. And the guidance that you offer does not include the potential impact of policy changes by the White House. Once we do get the actual tariffs announced and imposed, how quickly can Ford come out with some specifics, quantify the impact, and provide a new forecast? Is that something that you intend to do?
Of course. I mean, we're always transparent. I will be able to say, though, in our guidance, we can handle a couple weeks of tariffs. If it goes beyond that, obviously it will be billions and billions of incremental profit headwinds for the company. So, I think the most important thing is having a productive discussion with the D.C. leaders, the Trump administration, congressional leaders, about what this could do to our industry, what it means for U.S. jobs. And, they ran on a campaign of making the auto industry stronger. And that's what we expect. out of them as policymakers. We have a lot of policy decisions to make in the coming year. As I said, CO2, tax policy, and we believe that this administration, congressional leaders are going to back the U.S. industry, companies like Ford that have doubled down on the U.S.
Right. Okay. I want to talk a little bit about your EV business as well. The EV strategy clearly in overhaul mode. Your more affordable models that go further on a single charge won't really be available for 2 years. And Ford is kind of unusual in that you do break out your EV profits in your financial reports. When will you have visibility on those affordable models that go further on a single charge in terms of being able to really turn around that business?
Well, look, we made the decision. We've been number 3 to Tesla in the U.S. EV sales for 3 years now. We've been number 2 for 3 years, and we're also number 3 on hybrid. So we know a lot about these customers. We decided a couple years ago, based on what we heard from customers, that we really needed to redo our EV lineup. So we made that decision a couple years ago. You know, we canceled a couple models. Those vehicles are in development now. We would rather grow profitably than grow. And that's what we're deciding on. So this next couple of years, we're number 2 to Tesla, a long way below them, but we scaled to 100,000 unit plus for a couple of years now. We want to wait until those new vehicles come out in a couple of years, as you said, that will really transform our Model E profits. You know, they're designed differently. They're going to be manufactured different. They have a different supply chain. We've really learned a lot from Tesla, from the Chinese, from a lot of people on how differently we need to design these EVs to be profitable.
So Ford is committed to a long-term EV strategy then?
Absolutely.
What about?
Absolutely. I was just going to say, we see the people who buy EVs, they don't go back to combustion. You know, they have very high level of satisfaction with the vehicle. It's a small part of the industry in the U.S., only 8%, but it's growing. But the only way it's going to grow in a sustained way if it's a profitable business for us. And that's why we had to completely redesign our vehicle and our approach.
Jim, we want to really thank you for taking time for us here on what I'm sure is a very busy afternoon for you. Jim Farley there. He's the CEO over at Ford. Those earnings just out. And we should reiterate here, the numbers in the most recent quarter did beat, but some concerns here about the guidance going forward, largely because of costs and maybe some tamp down of pricing power. Those shares down 5% in the after-hours trade right now.
All right, let's take a look at some other notable movers in the after-hours trade, including Qualcomm. Qualcomm projecting strong revenue growth tied to smartphone sales. But as you can see right now, the stock is down about 3.7% at the moment in after-hours trade. ARM Holdings losing about 5.6% as well. We do have full-year revenue climbing to $3.94 to $4.04 billion. That is higher than what was anticipated. But again, that muted forecast overall is continuing to remind people of the costs of building out AI.
Hey, look at that. MicroStrategy. You know, you got to update the board there. It's now just called Strategy, Scarlett, and it's up 0.2%
What does it do
here.
again, Romain?
It sells, I don't know. Don't get me in trouble, Scarlett. A lot of other stocks actually to the upside as well. Coherent, Crown, Lumentum, and a few others. Becton Dickinson, as well as Allstate here. Not necessarily your favorites, but that's probably what's going to be leading in the cash session tomorrow. We'll be back in a moment. This is The Close on Bloomberg.
Today, Romain and I caught up with Wall Street titan and legendary short seller Jim Chanos. Jim Chanos had quite a bit to say about the cost of AI investment in the U.S. and what the market could learn from the DeepSeek drama that was only just 1 week ago.
When you are betting on disruptive technology, you have to always consider the risk that that technology will be disrupted itself by a better mousetrap. The kid in the garage. You know, we can talk about all of the possible risks, and that's something coming out of left field that I think can change the argument. So I think that's what DeepSeek underscored was that, well, wait a minute, maybe there's a way to do AI with less capex, less chips, cheaper, and nobody had kind of really considered that until DeepSeek.
So at least when it comes to big tech and AI, this threat of disruptive technology, do you see any evidence that institutional investors maybe have an appetite to start hedging or looking to protect against some of those positions?
Well, they should. I don't know if I'm seeing it yet, but they should. And as I said, there's and the other thing that I'll just mention about disruptive technology is in the up phase of it, as we saw in the late 90s when the internet, which was certainly a disruptive technology, everything is a positive. The internet will affect all things positively. And in fact, what we found and what I and my clients made a lot of money on in from 2000 to 2010 was how many businesses got unfortunately disrupted by the internet, how many businesses went away. And I suspect that's going to be the same thing in AI that not a lot of people are talking about yet. I mean, AI is a very revolutionary technology and will be benefiting lots of things and hopefully humanity. But by definition, it will put a lot of business models out of business.
And Jim Chanos there, who, of course, has had a front row seat to a lot of the revolutionary technologies and, of course, the investments made in them and, of course, a lot of money lost in some of them. And it kind of feels like it's all come full circle because we're back there once again with AI. The sector's outlook facing some uncertainty for a variety of reasons. That, of course, includes policy coming out of Washington, like tariffs, which our next guest says are being used as a weapon. And companies like NVIDIA, like Amazon, Microsoft are some of the most at risk from any sort of a trade war with China. Wang joins us right now. He is the CEO and founder of Constellation Research. He joins us from out there on the West Coast in San Francisco. And Ray, I do want to start there. I mean, we've heard from most of the big tech companies. I think we get Amazon this week, and we got to wait another 3 weeks to hear from NVIDIA. These are basically the kings of the world, one way or another. But over the last few weeks, or at least since their last earnings report, a lot has happened, from DeepSeek to the inauguration of a new president who is taking a much different approach than the last president. Are these still going to be the kings if we come and talk to you 4 years from now?
It's hard to imagine that these digital giants will have a downfall, but that is the case at the moment. We're looking at a revolution in AI, and it's a question of will these companies succeed? And going down the line, right? For example, NVIDIA, we're still going to need chips. The question is how many chips, and will somebody figure out a way to do this cheaper, faster, better, and cheaper, right? If you think about what's happening with Google, Amazon, and Microsoft, the cloud is key to being able to pull this stuff in AI. But what happens is everything goes on premises again. We go from cloud to on-premise for security, for power, and more importantly, trying to get that cost of compute down. So there are lots of factors that could happen, but I would say in 4 years, they're still going to be around. It might be that one of them is going to win and the other is going to have a slow death, but they will still be around.
Well, I mean, obviously NVIDIA, at least to date, has been pretty much the overwhelming beneficiary of all of the AI interests, if you will. Let's take NVIDIA out of the equation for 1 second. Who else is going to be the big winner? Because I know a lot of people right now, they're pointing to Microsoft. Some people are pointing to Meta, though I don't know if Zuckerberg has figured out that whole metaverse legs thing and how AI can fix that. But where do you see as kind of the potential winner outside of NVIDIA?
Romaine, it's a great question. On the chip side, ASML, we still have to print this stuff. ARM has the AI on the edges. I think that's going to be very important. And of course, you're going to see companies like Broadcom still succeed, but not because of chips, but because of their software business. When you start talking about what's happening in the cloud side, of course, Amazon has the best model. It's a digital giant that has 6 monetization models: ads, search, goods, services, memberships, and subscriptions. And that's what keeps that flywheel going. And Google has a good business in terms of they're vertically integrated. As someone else said, I think Mandeep was the one that was saying it earlier on your show, they're vertically integrated. They've got everything from chips all the way to the AI capability. So that leaves Microsoft at risk. And I'm going to say something, Microsoft is partnering to be able to deliver AI. Everybody else is trying to build it internally, from Meta on down and Tesla. So it's going to be interesting to see, will Microsoft launch their own AI after their partnership with OpenAI? So we'll be looking for those things.
Did he just reference our very own Mandeep Singh
from
Bloomberg Intelligence? Yeah, I was just going to
say, on a first-name basis, no less. Ray, very impressive. You mentioned that Microsoft is partnering up, whereas all the other big tech companies are doing it on their own. What's the better strategy?
Well, it depends. Microsoft was so far behind on AI, and they're so far behind on data centers. That's why they have to spend so much on CapEx to modernize their data centers. The good news is they've got Judson Aldous. The guy can sell everything. He can sell anything, and they're selling beyond their demand. So therefore, they've got to add capacity now to make it up. And you saw Google with the same problem with CapEx on data centers. They've got to add capacity. AWS just came out of a CapEx investment cycle, which makes Amazon very interesting to see because they can start reaping the gains of that CapEx investment.
So Romain mentioned earlier how you believe that certain companies are most at risk with China in this tariff tit for tat, whereas Google and Meta are not massively impacted. Does it surprise you then that so far Beijing has targeted Google, but not so much companies like Apple or Microsoft or Nvidia that are a lot more directly impacted? Does that suggest there's more bad news for those specific names to come?
Scarlett, I don't think it does. I think we have to understand what these tariffs are about. Phase one is to stop the fentanyl trade. Canada, Mexico, stop it. China, stop sending the prerequisites and all the things that are used to actually build fentanyl. This is about fentanyl. Phase two is about evening out trade. If your tariffs on U.S. cars coming into Europe is 40%, but European cars are coming to the U.S. at 10%, there's a reciprocity problem. Let's agree on 0, 10, or 40. So that's about trade. But then phase three is about national security, and that's going to be about EVs from China. That's going to be about chips and circuits. So we have to look at it in three phases. I'm guessing what the Trump strategy is, but it looks like that's what the first salvo was about.
There's a lot of talk right now, Ray, not so much about whether you're for or against some of the policies, but about some of the uncertainty and the chaos that is drummed up by the way that, of course, he makes these announcements kind of at a moment's notice and no one really knows, okay, is this actually real or is it not here? When we bring this back to the big companies, and particularly with an Amazon and some of the other companies after report, are they going to be able to weather that? And more importantly, are investors in those companies going to be able to weather that?
I think we're getting used to a new cycle. We had 4 years of news in 2 weeks. I think we're all very tired at this moment trying to keep up with the pace. And if you were coming out of Davos, you noticed that there were war rooms being created by every CEO to keep up with the EOs to understand what was happening. I think that pace will slow down as the year goes through, but it is quite a rapid pace of change. And what we actually have to understand is I believe we're trying to create a new world order, not just in where the U.S. is heading in terms of expansion, but in terms of trade. But there's a new game in town. And it also means the dollar is going to look differently in terms of a reserve currency based on some of the conversations we're hearing out of D.C. We might have a Bitcoin reserve, and that's going to be an interesting thing to think about cryptocurrencies and U.S. denominated currencies in crypto. So this is going to be quite an interesting shift. So there's a lot of things happening at the same time, not just on the economic side, but also on the political side and also on the societal side as well, as we have population dynamics changing as we have aging populations.
All right, Ray, have to leave it there. Ray Wang, the CEO and founder over at Constellation Research here. As we, of course, break down all of the big tech earnings that we got this week, and, of course, another big one coming up later in the week with Amazon. I do just want to point out, though, in the after-hours trade, I was taking a look. Skyworks Solutions, what we were talking about a little bit earlier, a big supplier to Apple, down 23% here. And I know that's not quite the AI story. It's not even quite the chip story here. But it gets to this idea that not all of these tech companies are moving in tandem in terms of their fortunes.
No, we're definitely sifting through and looking for winners and losers. The problem is that we're not sure what the different conditions are just yet. So you know what each company does and what their vulnerabilities are. We just don't know what the overall macro picture is going to be yet.
Yeah, absolutely. A lot to break down here on this day. Tomorrow promises to be even busier. We're going to set you up for what to watch when we come back after the break. This is Bloomberg. All right, a busy day for earnings, and the earnings season rolls on tomorrow. And we start in the morning with a couple of interesting companies that could give us a read on the consumer.
Absolutely. And Eli Lilly will be definitely one to watch for. They could not forecast demand for their obesity shot, so maybe they'll be able to provide some more clarity this time around.
Kellanova, Yum Brands, Tapestry, also scheduled to report in Peloton. Remember them? All right.
Subscription company, right?
Yeah, I guess. But they're having a little bit of a turnaround in the stock here. And of course, after the market here, we're going to get a really big one after the market tomorrow.
Yeah, and it's all about the cloud business for Amazon Web Services and how that looks. Microsoft and Alphabet disappointed on that front.
And there's going to be so many questions, though, for this company about, obviously, tariffs.
Yes.
I mean, the retail business is still a big part of their business, their e-commerce business.
Yeah.
And anyone who's been on Amazon websites knows there's a lot of stuff from China there.
Yeah.
Are we allowed to get packages from China anymore? I can't remember.
The post office is now allowing it again, so yeah, I think so.
So they'll get a lot of questions on that. Obviously, a lot of questions on AI and that CapEx spend. We also get some earnings from the travel sector.
Yeah, Expedia. And of course, that goes back to that idea of consumer demand and how it looked. This will be for the holiday season, so I would expect that it would be some pretty big numbers. But going forward, how are people maybe curbing their spending?
Take-Two, Pinterest also scheduled to report as well. And then we turn to the macro, and it starts at about 7 a.m. Eastern time.
The Bank of England comes out with this decision. It is expected to cut rates, but of course, everyone's going to be wondering about how the UK is affected by tariffs. Or how they also see the tariff picture playing out. Nobody knows anything on this front.
Absolutely. And then we bring it back to the U.S. here and that drumbeat to the official monthly jobs report on Friday. But we start, of course, with those weekly jobless claims numbers.
It's a high-frequency number, but what's interesting, of course, is that we had job openings fall to a 3-month low, but the ISM Services employment number came in better than expected.
A read on the economy, a read on corporate fundamentals. You can find all of that right here on The Close every day from 3 to 5 p.m. For all your politics news, stick around. Joe and Kaylee are up next.